All right, future CPAs, listen up. If you're a BS accountancy student, you know the drill, right? You cram, you memorize everything for the quiz, you absolutely nail it, and then, like a week later, poof, it's gone. We're going to fix that right now. Today, we're breaking down market value ratios with a totally new approach, one that's designed to make this stuff stick, not just for your next exam, but for the big one, the LEGPA.
So, here's our game plan for today. First, we're going to talk about how to actually hack your brain to organize this info. Then, we'll dive into the ratios by chunking them into 3 simple groups: what the company's own books are telling us, what the stock market is thinking, and finally, the actual cash you get back. And we're going to wrap it all up with the ultimate cheat sheet to lock it all in for good.
Does this sound a little too familiar? Yeah, I thought so. This is the cram and forget cycle, and it is the #1 enemy of long-term success. The LEPA isn't going to ask you what you memorized last Tuesday. It's going to test the foundation you've been building for years. So think of this as laying the first solid bricks for that foundation, instead of, just a flimsy house of cards.
Okay, so here is the hack. It's super simple. Instead of trying to brute force memorize 6 random formulas, we're going to chunk them. We'll group them together by asking 3 basic questions that any real-world investor would ask. Just reframing it this way helps your brain build a mental filing cabinet, making it way, way easier to pull out the right info when you're under pressure. First up, we're looking inward. We're putting on our accountant hats for this one. We're only going to look at the company's own data, the hard numbers from its balance sheet and income statement. This is all about finding the value based on historical facts and figures. No outside opinions allowed just yet. The most basic, fundamental starting point is earnings per share, or EPS. This is like the bottom line number for any shareholder. Whenever you hear on the news that a company reported its earnings, this is the metric everyone is obsessing over. It answers a really simple question. For every single share that I own, how much profit did the company actually make? It's your slice of the profit pie.
And the formula? It's pretty straightforward. You just take the net income, you subtract out any dividends you have to pay to preferred shareholders first, and then you divide what's left by the average number of common shares. So, quick check for your brain. What goes on the bottom of that fraction? Go on, say it out loud. That little action, that's active recall, and it's how you make things stick. Next in this group is book value per share. Now, this is a completely different idea. Think of it as the fire sale value. Imagine the company shuts its doors today. It sells off every desk, every computer, every factory, and pays off every single loan. Whatever cash is left over for the common shareholders, divided by the number of shares, that's the book value. It's purely a historical, on-paper accounting number. And hey, the formula totally reflects that. It's just the total stockholders' equity, pulled straight from the balance sheet, divided by the shares outstanding. So let's lock this concept in. Is this number based on what the stock is trading for on the market today, or what the company's books say it's worth? The answer's right there in the name. It's the book value. Okay, accountant hats off. Now we're stepping outside the company's office. We're asking, what does the rest of the world, all those millions of investors, analysts, and traders, what do they think this company is actually worth? This is where perception and reality collide. And that brings us to maybe the most famous ratio of them all, the price to earnings, or PE ratio. Honestly, this ratio is all about hype and expectations. It tells you how much the market is willing to pay right now for every single dollar of the company's current earnings. A really high PE means investors are expecting huge things, like massive growth in the future.
And would you look at that? This formula connects right back to the very first one we learned. See that? The bottom number, the denominator, is the EPS we just calculated. So you take today's stock price, you divide it by the EPS. So quick check. A sky-high PE ratio means investors have what? High or low expectations? High, exactly. You got it. They're paying a premium today for tomorrow's growth. Now, the market-to-book ratio is the perfect bridge connecting our first 2 ideas. It literally puts the market's opinion, the market value, head-to-head with the company's accounting opinion, the book value. So if the ratio is, say, 3.0, it means investors are willing to pay $3 for every $1 of stuff the company has on its books. And the formula is just as simple as it sounds. Market value divided by book value. That market value is just the stock price times the number of shares. So another check for you. If a company's market-to-book ratio is 3.0, is that usually a good sign or a bad sign? It's an awesome sign. It means the market believes in stuff it can't see on the balance sheet, like the company's brand, its smart management, or its future potential. So let's put these 2 market ratios side by side, because this is where people can get a little mixed up. Here's the key difference to burn into your brain. The PE ratio connects market price to earnings. It's all about future profits. The market-to-book ratio, on the other hand, connects market value to the company's net assets. It's about how the market values the company's tangible stuff. See, both measure market perception, just from totally different angles.
All right, for our final section, let's talk about what really matters to a lot of people: the cold, hard cash. At the end of the day, an investor wants a return on their money. This last group of ratios answers the big "what's in it for me" question. How much of the company's success is actually being sent back to me, the shareholder, in cash?
The dividend payout ratio is pretty simple. Remember that profit pie we talked about? This ratio shows you what percentage of that pie is actually served to the shareholders. The rest of it? Well, the company keeps it to reinvest, to build new factories, do more research, grow the business. So it's a trade-off. A high payout means less money is being put back in for future growth.
And once again, the formula uses our old friend EPS as the base. It's just the dividend you get per share divided by the earnings per share. It tells you the exact proportion. So, active recall time. A high payout ratio means the company is reinvesting more or less? Less, right? Exactly. They're paying it out to shareholders instead of plowing it back into the business. And last but not least, we've got dividend yield. Now, for an investor who just wants to see some regular cash flow, this ratio is huge. The best way to think about it, honestly, is like the interest rate on a savings account. It tells you exactly what percentage return you're getting in pure cash based on the money you put in, which is just the current stock price. Now, here's the formula. Dividends per share divided by the market price per share. Uh-oh. Notice something? The bottom number is the market price, not EPS. That is a crucial difference. So let me ask you this to test it. If a stock's price goes to the moon, but the company keeps paying the same old dividend, what happens to your yield? It actually goes down. The relationship is inverse. Okay, we have covered a lot. So now let's pull it all together into one powerful summary. Seriously, this next part is the most valuable section. Screenshot this slide, write it down, put it on your wall, whatever you gotta do. This is your high-density review sheet for crushing your exams and, more importantly, remembering this stuff for the LECPA. And here it is, the whole picture on one slide. This is how it all connects. See how it's organized by the key question each ratio answers? We've got the inside-the-books ratios, like EPS and book value. We have the markets thinking ratios, like PE and market-to-book. And the cash payout story. And notice how EPS is the building block for two other ratios? This one slide is your entire study guide. Look, the real secret isn't just about how many hours you study, it's about how you study. And today, we used a few powerful techniques. We chunked the info into logical groups. We used active recall with all those little questions. We used simple analogies to make concepts stick. And to really lock this in for the LCPA, you need to use spaced repetition. Just look at that cheat sheet once a week. I'm telling you, it works. So I'm going to leave you with a final thought to chew on. You find a company with a really high earnings per share, which sounds great, right? But the market isn't willing to pay a high price for it, so it has a low PE ratio. What does that tell you? Is it a hidden gem, an undiscovered stock that's about to soar? Or is it a value trap with a hidden problem that the market sees but you don't? Now you have the tools to start finding out.